Could your next landlord be a Wall Street giant? The race to own the American home is heating up and reshaping the very fabric of neighborhoods across the country. U.S. home prices have skyrocketed an astonishing 45% since 2020, while the construction of new homes has dwindled to a mere shadow of what it was in the 1970s. In the last few years, a seismic shift has rocked the housing market, transforming the age-old dream of home ownership into a complex game where big corporations on Wall Street are becoming the main players. Since the pandemic began, the average price of homes in the U.S. has soared, reaching an all-time high of $406,700. So, how is Wall Street's involvement reshaping the U.S. housing market? What factors are fueling the current housing crisis? And what strategies are being proposed to address the housing crisis? This steep rise has rendered home ownership a distant dream for a substantial portion of the American population, forcing many to opt for rental alternatives. Unfortunately, the surge in housing expenses is not complemented by a proportional increase in income levels. There is a growing sentiment in Congress that the influence of Wall Street is exacerbating the situation. Following the economic downturn in 2008, the value of houses significantly decreased, concurrently with the central bank decreasing the interest rates to bolster the economic condition. This scenario granted Wall Street an opportunity to acquire inexpensive funds and affordable devalued properties. Over a large part of the previous 10 years, interest rates have generally remained below the rental returns garnered from the majority of real estate properties. This situation facilitated a profitable business framework for corporate property owners. Enterprises, with financial support from private equity giants such as Blackstone and Pretium Partners, managed to acquire a substantial number of residences. Prominent private equity firms such as Blackstone and Pretium Partners are fostering a new era of home ownership, where corporations are becoming significant stakeholders. These burgeoning industries either purchase or construct single-family residences to lease them, altering the traditional fabric of residential neighborhoods. Community activists have voiced their astonishment at the considerable number of properties on a single street owned by corporate entities. Despite the apprehension, proponents of this industry argue that these corporate landlords are vital in addressing the persistent housing shortfall that has plagued the U.S. since the financial crisis. The pressing question now revolves around the strategies to bridge this housing gap, whether to stimulate new housing projects, investments, or to encourage new players to enter the market. Many industry experts believe that rapidly augmenting the housing stock stands as a primary solution to the ongoing issues in the housing sector. To draw a comparison, back in the late 1970s and early 1980s, the U.S. consistently produced between 300,000 and 400,000 starter homes annually. However, this figure plummeted to a mere 65,000 in 2020, indicating a pressing need to accelerate housing development to keep up with the demand. Approximately a decade and a half ago, the market saw a surge in the availability of homes, primarily fueled by Wall Street's precarious lending strategies. This led to a devastating crash in the 2008 financial crisis, with a massive number of individuals losing their homes. A staggering 8 million mortgages faced foreclosure from 2007 to 2016. This upheaval paved the way for institutional investors to step in, acquiring numerous distressed properties that were available at discounted prices. This intervention played a crucial role in stabilizing the plummeting home prices during that period. The government made a conscious choice to financially support these private equity firms in their venture into the housing market, a move that could be deemed necessary given the severely depressed state of the market at that time. This phase marked the inception of the single-family rental industry. Initiatives were undertaken to prevent mass foreclosures and the consequent significant losses for the Department of Housing and Urban Development. A shift in strategy saw many homeowners transforming into renters, a move aimed at minimizing overall distress. As a result, the single-family rental domain witnessed the rise of professional management, bringing a level of stability and organization to the sector. Although this was initially intended as a short-term measure, it has prolonged for over a decade, generating substantial profits for Wall Street entities. Despite criticisms, there is a segment that applauds the efforts of institutional investors, attributing them with offering premium products primarily to individuals in higher income brackets. It was discerned early on that focusing on a demographic with stable incomes and targeting newer properties required less capital expenditure, proving to be a more profitable business model. Given the current market dynamics with limited supply, these rental options have turned into somewhat of a refuge for those unable to venture into home ownership. This has inadvertently created a scenario where a significant portion of the population finds themselves in a cycle of perpetual renting, as the hurdles to enter the home buying market continue to escalate. Deciding whether to rent or purchase a home is a monumental choice affecting someone's financial stability. While owning a home has been the prime method of accumulating wealth in the United States, the distinction between renting and owning might not seem substantial at a first glance. But when it comes to the financial implications for families and the broader community, it is a matter of great significance. Interestingly, not everyone is inclined towards becoming a homeowner. Many appreciate the freedom that comes with renting, allowing them to easily relocate within their community or even to a different state. Recently, the ease of relocation has become highly valuable, and renting has emerged as a more popular option for a considerable number of individuals. To better understand the history of when it has been better to own or rent, we can take a look at this chart representing the cost of owning versus renting single-family homes. This chart illustrates the financial advantages of renting versus buying over different periods. For example, in much of 2021, and during other spans marked in red, buying a home was financially more sensible, particularly in the years after the financial crisis in 2008. This premium is influenced significantly by the variations in property prices and the rates of mortgages. The average monthly rent in the United States is now around $1,850, which is roughly 30% less expensive than the median monthly cost of purchasing a home at $2,700. This discrepancy marks an unprecedented divide between the costs of renting and buying in the history of the country. While the gap was under $200 in 2022, it has escalated significantly in 2023, exceeding a staggering $800. Over the previous 4 decades, the median home cost as a fraction of the home buyer's income hovered around 29 to 30%. Currently, this ratio has surged to an alarming 42%. A considerable number of experts are foreseeing a notable decrease in home prices soon, with estimates ranging from a marginal drop to a sharp fall of 10 to 15%. Nevertheless, the present scenario differs greatly from the time of the financial crisis in 2008. Primarily due to the ongoing imbalance between supply and demand. The limited supply of homes is anticipated to maintain a higher price level in the foreseeable future. To address the housing crisis, many experts think that the focus shouldn't be on restricting large company landlords, but on accelerating the construction of more homes. Several prominent real estate investment trusts, or REITs, are actively involved in constructing new houses, thereby increasing the much-needed supply. This approach shows promise, but it necessitates more time to establish its effectiveness. At the moment, only around 10% of the rental home constructions in the nation are actively being sold in build-to-rent communities, which is not sufficient given that 26% of tenants are looking for single-family homes to rent, outweighing the demand for apartments. However, there are individuals in Congress advocating for a decrease in corporate involvement in the housing sector as a preliminary measure. They propose introducing a tax on single-family homes purchased by Wall Street if they remain vacant for several years. This would encourage companies to sell these properties, increasing the availability of single-family homes on the market. But passing such laws would require considerable cooperation across party lines given the divided Congress. The proposed bills, which seem rather radical, aim to cap the number of homes that investors can possess, imposing hefty taxes on additional properties. Large corporate investors who currently own thousands of houses argue that their properties could eventually be sold to aspiring homeowners. Some believe that these corporations hold too many properties, suggesting the introduction of extra taxes on them to either fund affordable housing initiatives or persuade them to reduce their holdings. Support is also growing for implementing rent control and just cause eviction laws, along with other measures to guarantee the livability of a property. Despite efforts by numerous states to aid tenants with policies such as rent control, firms supported by heavyweights like Blackstone have resisted vehemently. For example, in 2018, Blackstone invested approximately $7 million to counteract rent control initiatives for single-family residences in California. Given the complexities, many believe that we are only in the early stages of finding a viable solution to this problem, implying that concerted efforts and time are needed to alleviate the housing distress.